Inflation pressures could see some easing later in the financial year on the back of strong Kharif sowing, adequate buffer stocks and good soil moisture conditions which are conducive for Rabi sowing. Adverse weather events continue to pose contingent risks to food inflation. Core inflation, on the other hand, appears to have bottomed out. Fuel component of the CPI remains in contraction. Domestic growth has sustained its momentum with private consumption and investment growing in tandem. Resilient growth gives us the space to focus on inflation so as to enable its durable descent to the 4% target. In these circumstances, the MPC decided to remain watchful of the evolving outlook in the coming months. Keeping in view the prevailing inflation and growth conditions and the outlook, the MPC considered it appropriate to change the stance to neutral and to remain unambiguously focused on a durable alignment of inflation with the target, while of course supporting growth. I would now turn to an assessment of the growth and inflation situation. First, let me talk in brief about the global growth conditions. The global economy has remained resilient since the last meeting of the MPC in August. Although downside risks from increasingly intense geopolitical conflicts, geoeconomic fragmentation, financial market volatility, and elevated public debt continue to play out. Manufacturing is showing signs of slowdown while services activity is holding up. World trade is exhibiting improvement. Inflation is softening, supported by lower energy prices. Growing divergence in inflation growth dynamics across countries has resulted in varying monetary policy responses. Let me now turn to domestic growth. Real GDP grew by 6.7% in the first quarter of this financial year, that is 24-25. And this was led by a revival in private consumption and improvement in investment. The share of investment in GDP reached its highest level since 2012-13. Government expenditure, on the other hand, contracted during the first quarter. On the supply side, gross value added, that is GVA, expanded by 6.8%, surpassing the GDP growth, aided by strong industrial and services sector activities. High-frequency indicators available so far suggest that domestic economic activity continues to be steady. The main components from the supply side, that is agriculture, manufacturing, and services, they remain resilient. Agricultural growth has been supported by above normal southwest monsoon rainfall and better Kharif sowing. Higher reservoir levels with good moisture conditions of soil augur well for the ensuing Rabi crop. Manufacturing activity is gaining on the back of improving domestic demand, lower input costs, and supportive policy environment from the government. 8 core industries output fell by 1.8% in August on a high base. Excess rainfall also dampened the production in certain sectors such as electricity, coal, and cement in August. The Purchasing Managers Index, that is PMI for manufacturing, at 56.5 for September remained elevated. The services sector continues to grow at a strong pace. PMI services at 57.7 in September indicates robust expansion. On the demand side, rural demand is trending upwards while urban demand continues to hold firm. Government consumption is improving. Investment activity remains buoyant, with government capex rebounding from a contraction observed in the first quarter of this year. Private investment also continues to gain steam on the back of expansion in non-food bank credit, higher capacity utilization, and rising investment intentions. On the external front, services exports is supporting overall growth. Looking ahead, India's growth story remains intact, as its fundamental drivers, namely consumption and investment demand, are gaining momentum. Prospects of private consumption, the mainstay of aggregate demand, look bright on the back of improved agricultural outlook and rural demand. Sustained buoyancy in services would also support urban demand. Government expenditure of the centre and the states is expected to pick up pace in line with the budget estimates. Investment activity would benefit from consumer and business optimism, government's continued thrust on capex, and healthy balance sheets of banks and corporates. Taking all these factors into consideration, real GDP growth for 24-25 is projected at 7.2%, with